Hello and welcome to this video where we're talking about risk management in trading, presented by spreadbettingportal.com. One of the first things you really need to understand is that risk management is hugely important. It's one of the key things to understand with regards to trading. And risk management essentially in trading is about having a plan. And it really just breaks down into how much you're prepared to risk per trade, where your stop loss will be, which is basically where you will look to close the trade automatically should things go wrong, or where you're locking in some profit and you're looking to get out. And so that's where you will be looking to close the trade, whether in profit or not. And rules for change. If things go badly wrong in terms of, if things are going to change dramatically, what happens? And in terms of, how much you're prepared to risk on your whole account before you maybe stop trading altogether. Or if things are going really well for you and you're making a lot of profit, how much more you're beginning to look to invest more in each trade. One of the things which is really alarming is that a lot of new traders usually ignore risk management. Don't. It really is key. As long as you have, and they don't have to be overly complex, it really is it's simple in a lot of ways, but you really have to have those strict rules with yourself to managing your money. Because without risk management, you will lose more money than you would with it. It's basically there to protect you and your trades, and protect the money that you've worked hard to deposit and to trade. So you have to really treat your trading as you would as if it was a business. And businesses have risk management. They understand exactly what they're doing with money, why they're doing it. They have these contingency plans as to if things go wrong, what they would do. And you really have to start to look at your own trading in much the same way. And this is about having a risk management there. And one of the things that a lot of people, new traders, in fact some experienced traders too, they don't. A great place to start, and they don't really realize it, is don't really look to make money initially. I know obviously long term you're looking to make money, but at the start when you begin to trade, just simply look to maintain the balance at around what you deposited whilst you're trading. If you can keep the money that you've deposited, just learn to try and keep the amount the same as what it was when you first opened the account. That's what you should begin to look to do. Then from there you can look to add profits and make money. But to begin with, just try and learn to trade and to keep your balance pretty much where it is. Obviously look to make profit, but a lot of people just kind of fritter away their deposits so quickly, and before they know it, trading's a mug's game, and it's just con and this, that, and the other. And usually the reasons why a lot of traders do that, new traders get out of trading, is because they didn't have any risk management. They were getting too greedy. They were over trading to begin with, and they were just instantly looking for profit all the time, and just being too risky with what they were doing. And if they had a risk management, this sort of firm rule in terms of how they trade the deposit, they would still be trading. The other thing is never trade without a stop loss. It's like an AMEX. Never trade without it. Never go home without it. Always allow enough room in any trade for a trade to move. Certainly if you're using one of the techniques that we're explaining in one of the other videos where we talk about the golden cross or swing trading. One of the common mistakes that we see with new traders is that they tend to put the stop too close to where they're trading. And there's a common, or an old saying, death by 1,000 stops, in terms of where they're placing a trade, they're putting the stop too close, and because they're probably through inexperience, or I don't know, the market, not really understanding the market's moving a lot during the day as well. And of course they're getting stopped out because their stop is too close to where the market opened. And because there's a spread to pay to the broker on each and every trade you make, they're losing money. Their account is gradually being eaten away by the spreads that they're paying. Because of all these stops, a stop always is initially you can't put a stop in profit because you've not made any profit, so you're losing money there too. So don't place a stop too close to your open initially. Usually it's a good idea to place it at a moving average point. One of the most common ones to do is look for a 50-day moving average, and that gives you a great place to begin to look to where to put a stop, because it gives enough room for a trade to breathe and the market to move, but it also protects you enough to stop you from sort of getting any sort of really huge, massive losses. So here we can see, for instance, we've got the 50-day moving average and the red line here, and say if we were trading a long trade here and we're going up and up and up, we would put the trailing stop just there, and then say if we were trading a swing and it was getting towards the top of the trade, we would look to close out probably around about there anyway, but we're always protected by a trailing stop and the red there. So it kind of gives enough room for the trade to breathe, for the trade to move and do what it needs to do because of these market fluctuations. A common mistake is that they just put the stop way too close and they're just getting knocked out day in, day out. And a common thing is that, you'll see people, traders, new traders, enter the same trade again because, it's still going up, so they'll enter it again, too close to stop, and they're getting stopped out again. So don't do that. In terms of where with your deposit, never ever trade more than 10% of your balance at any one time. You've got to have some reserves there, so don't overtrade. That's a very common mistake. Don't 10% of your balance at any one time, and that's on all your trades. So no more than 10%, and no more than 20% of that 10% in any single trade. So don't place one trade at 10% of your balance. Just a maximum of 20% of that 10%. And the other thing is, don't make excuses to change that. These are the risk management rules. These are the rules to stick by. The other thing is, know where your profit's coming from. Don't just trade speculatively and hope that it's going to make a profit. You should know from using the supports and resistances and where the turnarounds are likely to be from those. You should be aware of where your profits are likely to be. And sometimes they can happen. These turnarounds can happen a lot earlier. We can expect and begin to see a bullish move. Say, for instance, where we have this, this bounce from support. It's starting to think, and we're looking to say enter there, and we think, it's going to bounce, and so people are entering too early, and they enter it, and it's only bounced a little bit and then drops again. That's kind of a false move. Or this bounce here, where it's bounced and it's dropped through the resist, through the support. So there's always surprises to be had in trading, and you kind of have to work with that. But as providing where the supports and resistances are, and kind of how the market is moving, you can have a relatively good idea as to know where your profit is likely to come from. And the other thing with that is, don't be afraid to take profit too early. Nobody's ever gone poor. No trader has ever gone broke by taking profits. And profit is profit regardless. Don't beat yourself up for taking a small profit when you see the market move and you've taken some money, and then you see the market move some more, and you think, I could have taken more money out of that. Yeah, you could have if you stayed in the trade, but you didn't. And the good thing is you still made money. Conversely from that, you could have taken the profit and it could have gone, the opposite way, and it would have wiped away the profits that you wouldn't have taken initially. So don't be afraid. Certainly if you're making a lot of profit that you probably wouldn't have expected of so soon, never see it as taking profit early as a bad thing. And one of the safest ways of doing that is locking in profit by moving up your stop. So you can do that quite early if you want to. But be aware of not placing the stop too close if you still want to be sure of being in that trade. If you're not sure of wanting to still be in that trade, then you should be closing it straight away. Remember that trading is also about patience. Don't force trades that aren't there. A lot of people to begin with are so desperate to trade. They're so eager to trade that they'll trade anything. And if you're not seeing a trade, if it's not set up there, if the supports and resistances aren't there, or the trends aren't there, or the moves that you begin to understand, or the patterns aren't there to begin with, don't trade them. The market, there's so much in the market, so many charts in the market. There's another day. Just see it as learning and enjoying it. And if you want to trade, do it virtually through the many sort of free accounts that you can trade virtually with money. If that's what you want to do, do it on a virtual account. Don't trade with your real money. Don't force trades that way. Because doing so is pretty much the same as gambling. You're just taking a punt. You're not doing anything in terms of analysis. You're not trading anymore. You're just gambling. So don't do it. One of the main things is keep calm. Just keep calm. Don't stress about your trading. Remember, this kind of ties in with the whole making sure that you're trading with money that you can afford to lose. So providing you're doing that, don't stress too much if you're losing money. Try and understand why you're losing money. Keep a trading journal that monitors all the trades that you are doing. Keep an eye on how you're feeling that day. Write a diary of your trades and how you're feeling that day. Sometimes, and a lot of times, your emotional state can affect your way you're trading as well. So keep calm. So there we go, you guys. Don't forget to stop by and say hello at spreadbettingportal.com. Come and pay us a visit and watch more training videos and read some great articles on trading and find some of the most amazing deals that are available from some of the leading brokers out there. So come and visit us today at spreadbettingportal.com.